right, so I'm joined today by Chris Cullen, the SVP at Brompton. He actually manages all the cover call ETFs at Brompton. So Chris, thanks again for doing this. I really appreciate your time.
Hey, Adrian, thank you so much for having me on. It took a little while for us to connect like this, but I'm so glad to be here today.
My pleasure, my pleasure. And just to give my audience a heads up, Chris manages the covered call ETFs for Brompton. I know I talk a lot about the split funds for Brompton, so don't worry. I'm actually gonna have a second interview with Michelle, who is the split fund manager. So today's video will focus on the covered call ETFs. The split funds will focus on a subsequent interview later on. So I just want to make sure, because I'm sure I'll get all kinds of questions right away.
One clarification I'll make for you, Adrian. I'm the business head for our ETF group.
Okay, perfect.
So I'm the head of the front office. That's I work on with the sales team and I manage the product. And we have a portfolio management team that takes care of the investments. And you'll be hearing a bit more today about the way that they approach.
Perfect. So you're even more important then. You're even more important. That's great.
Well, it depends who you ask. It's my mom thinks I'm pretty important, so that's the only thing that counts, right?
Awesome. I love that. That's perfect. So
good.
Let's get into it right away. As you know, we've had discussions, email back and forth before. You know that the bread and butter of my strategy, my channel talks a lot about covered calls. So I guess my first question, we could hit it off in 30 seconds or less. Can you describe in your own words what actually is a covered call ETF and for what type of investor are they designed for?
Sure. I might need 45 seconds, but I'll keep it short.
Not a problem.
So we have currently 9 ETFs on offer. 7 of them are equity cover call ETFs. Brompton's been in the cover call business since 2004, writing cover calls on our split share funds. And when we expanded into ETFs in 2018, we took a lot of that expertise with us to the cover call space in the ETF area. So what is a cover call? I guess let's start with what is a call option. So a call option really is a conditional sale contract that 2 investors enter into. And when I say conditional sale, what it means is that if I want to sell a call option to you, we agree on a price that sale might take place at. That's called the strike price. Let's say we're talking about a $50 stock and I'm selling you a call option. We might agree to a strike price of $60. So if you want, you can pay me a premium. That's the income part of the cover call. I own the stock, so that's the coverage part. I'm covering the short sale of a call to you by owning the stock to deliver to you in case you want to buy it at $60. It's only worth $50 now. If it goes up to, say, $65, you might decide that it's a good time to exercise your call option and call away the stock from me. So it's worth $65 at that time. You only pay $60. So what I get in return for this, in this case, a bad deal, is an upfront premium. So you might have paid me $1, $2 for the right to call away my stock. Right. So that's the basis for this idea of cover calls. We've got a portfolio of equities, and on some portion of the portfolio, we've written calls, and the portfolio provides coverage for those calls. So that premium that our fund receives in return for selling the call is what we would think of as option premium income or cover call income. So really putting together packages of portfolios with cover calls to help to enhance returns and to generate a little bit of extra income can boost income for investors, and it can decrease risk too. In a lot of ways, the price of cover calls, that if I sell you a call, the price is very dependent on the volatility of the stock.
Right. And
so a call, me selling a call to you, can also be thought of as me selling volatility to you and receiving cash in return. So cash is a lot less volatile than a call premium or the call price. So that effectively reduces my volatility by selling that option to you up front. So I mean, this is a great income enhancing strategy for many types of investors. Really, what you need to be concerned with is the investor's risk tolerance. Do they have the ability to stomach the risk of an equity portfolio that has a slight risk reduction because of a cover call strategy? Right. If they do, again, it's a good equity income strategy to partake in.
Yeah, great explanation. I love that. And just to go back to your example, you used the example of a $50 stock selling a call at 60. And if the stock goes to 65, you're called away. But anything under 60, you're not called away. You get to keep the stock, you get to keep the premium. So essentially it's like extra cash, right? So it depends on every contract. It's usually, correct me if I'm wrong here, it's 30 days usually.
That's usually our target. Yeah.
Okay.
I mean, it's kind of technical, but the you get the fattest premium. It's known as option decay. Okay, so options are the pricing is dependent on the volatility of the stock and the time to expiry. And what you see is that options kind of have value and they lose it over time, and then in the last month they go like this. They go to zero at the end, assuming that they're expiring out of the money, assuming that there's no opportunity for you to call my stock away. And so focusing on the short end of the option time frame, it helps to generate the highest levels of premium because the drop from whatever the premium value is to zero is the most pronounced in shorter time frame. So generally we would look at 1 to 2 month periods for writing covered calls because of that. It maximizes the premium.
That makes sense. And yeah, I see that all the time. It's usually 30 days, sometimes it's 60 days, but typically the shorter, like you said, the fatter the premium, right? So excellent. Yeah. So I love covered calls. Thanks for discussing it.
Please do.
Do you see a trend? I asked all fund managers this. Do you see a trend where covered call ETFs are getting higher in demand? Is the demand for this type of product consistently rising? Has it been flat, would you say? Or do you feel like in today's low interest rate environment, the demand is actually going up?
Yeah, you nailed it. I think it's the world we've been living in terms of interest rates that is driving increased demand and increased interest in covered calls because of that. Right now rates are rising. The 10-year yield has gone to maybe almost 2%. That's nothing in historical context, right? Investors can't expect to generate enough wealth to invest in treasuries at 2% and fund their lives and their retirements, right? So alternative income is really gaining more and more acceptance and more interest in the market, and covered call ETFs are really part of that whole equity income story. That's helping investors meet their income needs. So yeah, very much so increased interest in this area.
Yeah, who do you feel these covered call ETFs are best for? I know I'm very popular. My channel is very popular with retirees, people who are part of the FIRE movement, like I am, who are retired and need the passive income. So I always tout them as a really good option for retirees. What do you think about that?
I think that again, it's about risk tolerance. If a retiree absolutely can't sleep at night, thinking that they're holding large cap stocks that might have a kind of mid-range volatility of 14%, 12%, something like that, then no, they shouldn't get involved. If they have equity risk tolerance, which most investors do, I have a portfolio myself that's mostly equities, then this is up for consideration. I think that there's benefits to considering covered call ETFs in that case, but it's up to the individual investor. I would never say that this applies broadly to all the FIRE investors out there or all the retirees out there. It's got to be an individual choice based on risk tolerance.
True, because in the end, it is equities, right? The underlying is always the equities. You're just getting it in a little bit more of a defensive way, right? Less volatility way, right? Okay, perfect. Exactly. So now to discuss Brompton specific covered call strategy. So there's many covered call providers in Canada. You got BMO, you got Harvest, you got Brompton and CI and other ones. Everyone seems to have their own vision, their own strategy on how they write their covered calls. So some of them it's, on 50%, like BMO's set in stone, pretty much 50% of the portfolio, always out of the money. Then you have CI that's on a quarter of the portfolio, but at the money. So what's Brompton's strategy when it comes to, the moneyness of the options, and the strategy itself, the portfolio coverage?
Yeah, well, I mean, just to take a step back, our portfolio management team is a fundamentals-based active management group. So what that means is that they're just out there, they're doing research, they're meeting with different companies that are potential investments, and they're looking for value. They're looking for situations where the stock price doesn't reflect the earnings generation potential for a company or some other aspect of valuation that makes it an attractive buy. Or they take a barbell approach. They have about roughly half of the portfolio would be looking for value, and the other half of the portfolio would be growth opportunities too, where the stock price doesn't reflect the upside potential in earnings, let's say, for certain types of stocks. So they try to take a balanced approach there, and they use a very fundamental technique. And the option writing is really just given to the PM team to use at their discretion to help to improve returns where they see fit. So again, they take a lot of that fundamental focus, and they also apply it to the derivatives market to look for positions to improve total returns by writing covered calls, right? So covered calls, we just view it as another tool in the tool belt for our active PM team. And they're not required to write covered calls at all. or they can write cover calls on the majority of the portfolio just based on the situation. I mean, I'll tell you that in 2021, cover call rating was very light by the PM team. They had a view that there was still a lot of recovery left in stocks, and cover calls, as we talked about earlier, right? It establishes conditions under which I would sell my stock to you for a prefixed price. They viewed that in 2021 as there was relatively few opportunities to add value that way because the upside potential was so great for many of the stocks that they were looking at. There's certain years when volatility is very high and the markets are sideways. 2022 might be one of those years where there'd be more coverage of the portfolios because they don't see everything going kind of up and to the right. There might be volatility, and they're going to get paid for monetizing that volatility through selling covered calls. So an entirely discretionary approach, and it's used by the PM team in a fundamentals driven fashion to improve total returns.
Okay, so nothing set in stone. It sounds to me like it's very active, dynamic, depending on market conditions, where the focus is really on total return. So like you mentioned, I'm assuming, correct me if I'm wrong here, but what I understood is if you feel that the market has potential to recover, you'll write a lot less calls to capture more of that growth. And then when you feel the market is probably going to go a bit sideways or be a bit flat, maybe then you'll write more calls. So it's a very dynamic approach, which focuses more on the total return above all else.
Yeah, that's right. That's a good way to summarize it.
Perfect. That makes complete sense to me. Now the holdings. So you guys have a nice suite of covered call ETFs. You have, tech one, healthcare one, financials. What does Brompton do in terms of, to analysis to how do they decide which stocks to put in these ETFs? Is it fundamental? Is it technical? Is it both? A little bit of both? What's the process?
For 6 of our 7 ETFs that are equity focused, it's a fundamentals approach that's taken. So, our PMs will do run valuation models. We'll talk to companies about their plans and what areas of business they're looking to get into, and they'll take a high level strategic view of the industries that those companies are competing with, and they'll try to select the winners. Either based on the current market value is below what it should be based on our estimates, or the current market value is not reflecting the growth potential in this stock, and so it should be worth more. That would be the growth side of the portfolio. So that's really the approach that they take. And again, they're also, when it comes time to writing cover calls, they're combining the view for short-term returns in the stock, and they're using their valuation techniques to decide if the premiums available on calls at this time is worth giving up that growth potential at some level. Right. So that would kind of describe how we fit in. We're not a passive manager on our cover call ETFs. We're not solely growth or solely value. It's a blend, and that's just to kind of hedge your bets. You don't know what month growth or what month value is going to be in favor. There's a strong value rotation last year. People that were solely invested in growth may have been caught unaware at that time. But we have a blend, so it was it played to at least one side of our portfolios here.
Yeah. Yeah, and I have noticed
that. What you're looking for?
Yeah, that's perfect. I mean, I do a lot of, I definitely put my 10,000 hours in when analyzing different fund managers that have covered call ETFs. And I do see what you mean by Brompton's a little bit more active, not passive, because I've noticed that in even your split funds, the covered call ETFs, sometimes when I go back and check the holdings, there's some new ones or some different ones. So it's obvious to me that you guys are a bit more active with which stocks you select in your funds, which I like. It means that you guys are doing the fundamental research that us retail investors don't have the time to do, and don't really have the skills to do, in my opinion. I know I don't, which is just another advantage of professional management, right?
Yeah, I mean, me neither. As I said, I'm more on the business side than on the portfolio management side. I'm not at all on the portfolio management side, and my investment portfolio is all Brompton ETFs. So it's ETFs and split shares, which we won't get into today because my partner Michelle, I think, will cover that with you in a couple weeks' time.
Not a problem. Okay. Not a problem. Regarding the distributions, now you guys have monthly distributions. How are the distributions decided? Are they set in stone for the year? I know this is different from fund manager to fund manager. What are your factors when you're looking at how much or deciding how much to distribute every month on these covered call ETFs?
Yeah, we generally we just went through our process in December, where we have a team meeting with the portfolio management team, the sales team, marketing, myself, our CEO, and we review distribution levels at each of the funds, and we decide for next year roughly where do we think our view is on where these distributions should be. The levels are set rather than because we have a completely discretionary call program, we don't set the distributions by saying, well, we're going to target 6% in this fund, and we're just going to write cover calls to cover, to generate enough premiums to pay out under that 6% scenario. We take more of an approach that, what are the returns prospects for this fund in the next year, in the next 5 years, in the next 10 years, and we try to come up with a view that's reasonable and makes sense, and we set the distribution levels at a level that we believe is sustainable, that won't overly tax the net asset value of the ETF, because we think that investors value their equity ETFs to go up as well as to pay out income. So, there's a balance that you have to strike there. If you set the distribution level too high and your fund can't generate those total returns to support the distribution, then your NAV goes down. So that's what we're trying to avoid. We're trying to pay out an attractive distribution that's set at a reasonable and sustainable level based on our view of the outlook for each of the investment areas that our ETFs cover. Okay, perfect. Yeah, from what I'm hearing, you guys are really focused on some growth as well, and total return is the most important thing for you guys, which a lot of my audience members, some of them would rather take less income and see some growth. So Brompton ETFs will probably be perfect for them. I mean, it makes sense to me if that's, if you're looking for a little bit of growth and maximizing total return versus just maximum income, right? Every investor is different. So fantastic. All right, good. Now a couple of hard questions. Well, I think they're hard questions, a bit of more. Making me sweat here, Adrian. I love asking these. This is one of my favorite questions to ask all fund managers. I love to get their opinion on it. Am I wrong in stating that covered call ETFs or the covered call strategy, covered call income, however you want to word it, is an infinite source of passive income? And what I mean by that is that, it's basically options trading. Options trading has been around for a long time, like we discussed earlier. And I think it's here to stay. So what's your opinion on that? Would you say that it's, I don't know about infinite, but. Well, first of all, Adrian, I would never tell you that you were wrong about anything. So let's establish that right up front. You're too nice. But also, my comments would be this, that infinity is really, really, really big, probably too big to apply to the covered call option space. Second thing I would say is that I feel somewhat in the industry, in the fund industry, that sometimes covered call providers focus only on the upfront premium, which we discussed earlier, and that's the income part of covered call writing. But they don't really talk about the expense, and the expense is the potential of leaving money on the table by writing these covered calls. Right? We talked about how I have a $50 stock. I write a $60 call option for you. You pay me $2, right? So my position, if I'm exercised, is the most I can generate out of that whole trade is $62. You pay me $60 and I got a $2 premium. You ended up with a $65 stock. I'm out of pocket $3, right? So I either I have, if I want to stay invested in the stock, I either have to buy it back at a higher price than the combined call price or the strike price and the call premium I received. So I'm out money, right? So really what we're trying to do here is at Brompton is take a view of the total life cycle of the covered call process and take into account not just the income, but the potential costs at the back end. And so in that way, I would say that there's a rich availability of net income opportunities in the covered call space. But infinite is I wouldn't go as far as to say that it's infinite. I think it can be a very valuable tool in contributing to overall returns of your portfolio. Yeah, no, you have a good point. Does that answer your question? Yeah, it does. It does. I mean, you have a good points. Basically, my audience, I say this all the time, where the covered call strategy usually does not shine is during a strong bull market. Like you said, you might give up that you're losing $3 on that perfect example that you gave, by the way. I love that example. Great. So you're making that premium, but you lost a lot more on the upside. So that's why typically covered call strategies underperform during a strong bull market. But I like the fact that you guys have an active dynamic approach because you'll write a lot less calls, if any, right? So you're really protecting the fund that way for the long term. So that's a perfect answer. I love that. So we don't our PMs don't have crystal balls, but they have a lot of experience and they have pretty good heads for this whole process. So they've done a very good job in creating value for investors by considering the whole life cycle of the covered call program. Correct. Perfect. So this question's a bit tough, but I got to do it. My audience wants to know.
So basically, and we kind of already discussed this already. So the Brompton dividend yields for their covered call or ETFs, they're typically lower than some competitors like Harvest, CI. So why is that? I know we discussed it already. Is it because they're more growth or total return oriented instead of income oriented?
Yeah. Well, this is the outcome of our approach, in that we are considering income and expenses, and looking at the net contribution to total returns that our covered call programs can add. And we're trying to take a view on sustainability on distribution levels, in that we're not trying to pay up everything and more that the fund could possibly generate. I don't know if you realize this, but very, very high distributions for ETFs can help to sell ETFs. So in some cases, there's a little bit too much of a marketing spin, I think, on setting an 8, 9, 10% level of distribution. You just got to take a close look, I think, at sustainability of distribution levels. And that's what we do. And that's really the reason why we do come in. I'm not going to point it to any of my competitors at all, but we do come in at an attractive, but we're definitely not the highest distribution payers in the covered call space. Yeah, just for those reasons.
Yeah. And one thing I would want to point out to my audience here is that, first of all, just to tell you, Brompton, one of the best and nicest websites. You guys have a really good, the way you show the funds and the information, my opinion, one of the best ones. And I especially love your performance tab, because for each one, you click on performance and you see since inception, the average annual return. So if someone is trying to compare, like a Harvest or a CI ETF of the same theme to a Brompton ETF, you could usually go there. And from what I've seen, Brompton sometimes has higher total returns, because like you said, that's what you guys focus on. So yeah, really nice website, by the way. I have to
thank you so much. Thank you so much. You have to tell that to Michelle when she comes on, because she also heads the marketing team.
I think I already told her via email a few times, because I'm like, I just appreciate where you could see the yields, especially the split funds, the yields, the unit NAVs, even the ETFs, you see the yields all listed. It's very, very rare to have that. Usually you got to kind of click one at a time for other fund managers. So yeah, really cool website.
We want full transparency, and we want a good client experience. So we do focus on that aspect of our business too. Just it's a big communication tool for us.
My opinion, top marks for that.
Great, thank you.
All right, almost done, Chris. I know I'm taking a lot of your time. I have just two more things I want to discuss. I was looking at the covered call, your lineup, and I saw two ETFs that are a little bit more unique, in my opinion. I don't see, the healthcare one. There's a bunch of them. There's a few of them. The tech one, there's a bunch of them. But I saw two that are kind of interesting. They're unique. So you have BLOV, which is one that you called a low volatility one. And you also have BREA, which seems to focus a lot on real assets like infrastructure, utilities. So, and those are kind of more the new ones. So can you give me the background behind the North American low volatility dividend ETF, stock symbol BLOV, for my audience, and then we could discuss BREA as well.
Sure, definitely. I mean, the low volatility factor, it comes out of something that's known as factor investing. There's a number of academic studies that are done, and you could read them if you're having trouble falling asleep at night. But honestly, they're very in depth, do very long-term studies of stock markets, and try to determine what factors or what are the features of a stock that make it outperform or that add to its returns over time. And there's a number of different factors that finance theorists have come up with, there's a growth factor and a value factor, and low volatility has actually shown to be the biggest contributor to returns over a very long period of time. I mean, our PM team reviewed data that went back as far as 90 to 100 years in the stock market. And it's an anomaly, really, that stocks with low volatility have had such success at performing. So not only do they give you lower risk because they're low volatility, but in many cases they've had as high or higher returns than the market in general. There's a number of reasons for this. One that I like to think about is called the lottery ticket effect. So when you have a year like 2020 after March and 2021, what you have is a lot of investors that switch to risk-on behavior. So you end up with things happening like Bitcoin going to the moon, and you have meme stocks. You got AMC and GameStonk or whatever right. Other meme stocks you have, right? But these are all like extremely high risk situations. Yes. And retail investors are chasing after them. Like, I mean, another interesting fact is that retail options flows spiked to levels that were never seen before, because investors are buying call options and basically when you own a call option and you overinvest, you're taking a leveraged risk on that stock. You might go to zero at the end of the month, right?
Yeah.
So risk-seeking behavior often ends in tears. But in the meantime, while everybody was focusing on these high risk and hopefully high reward opportunities, their lottery tickets, come on, big money. In the background, ignored stocks are chugging away and they're making gains for investors, and they're doing it in a lower risk fashion. So this low vol strategy, it really takes on that whole approach, that it's seeking out a portfolio that in combination, all the stocks in it will have the lowest variance, which is related to volatility, right? Have the lowest variance that our quant model can come up with. Now, I told you that we had fundamentals on most of our ETFs. And actually, I got to add that BLOV is a quant. I guess it's a quantamental offering. So we have an analyst that's an excellent computer programmer, and he came up with a way to, on a periodic basis, review thousands of stocks that are available in the market that meet our criteria, which is to have a minimum market cap that's substantial. It's well over $2 billion in North America, and also has a minimum dividend level of 2%. So we added a dividend screen in there as well because we're interested in income. And so that's coming up on, they're rebalancing periodically and coming up with a new low variance portfolio. And the intended outcome is to take advantage of this low volatility effect and provide investors with better risk adjusted returns. Option writing is also available on the low vol portfolio. I got to say, it would be a harder decision to make to write options on a low vol portfolio because, as I mentioned, volatility drives premiums received for written calls. So there'd have to be a special opportunity to get a nice premium that would outweigh just holding the stock for that fund. But that's the idea for BLOV. Now, low volatility investing has been out of favor since the March 2020 drawdown in the markets, as investors focus on those higher risk and hopefully higher reward opportunities. But in 2022, we see this really coming back. Markets are getting unsettled, and being in a low volatility ETF is actually sounds like a pretty good idea to me right now. Yeah. So that's where we're going with that ETF.
I love the reasoning. I love what you said about the analogy about the lottery. I love that.
Yeah, that's a real thing. That's a real academic theory.
Yeah,
the lottery ticket effect. But
it's been increasing. Like the retail investor now has, because of all the technological advancements, you got Robinhood, and it's so easy and quick to buy options now. Like you said, it could end up in tiers, or worse actually than tiers. So I really like that. And I always tell my audience, stay away from all that stuff. Slow and steady wins the rat race. That's one of my models I tell my audience. So this ETF, I'm looking at it now, and it really doesn't surprise me when I look at the sector allocation. I really understand why you call it low volatility. I mean, 33% of it is consumer staples, things like Costco, Loblaws, Coca-Cola. Then the next one is communication services, Bell, Telus, etc. And then you have utilities, healthcare. So most of these are all very, very defensive sectors, right? Defensive sectors. So I really like the premise behind this ETF. I would probably suggest it to someone who's retired, who wants really low volatility, who wants really good quality companies. Like you said, you have a quant approach for the companies you select, and I'm looking at all of them, and I would have, these are all, they look like defensive, very defensive. You got some materials in there too. So really
the materials is an interesting one because materials is thought of as a higher volatility sector, but we're trying to construct not a portfolio of individually low volatility stocks. We're trying to put all these stocks together and create a portfolio that's the lowest volatility. And so having a couple of stocks in there that maybe don't move in the same direction as all the others helps to dampen out volatility, right? Maybe utilities and healthcare as defensives would go up and down with each other, but a mining stock might move in the opposite direction. And for the whole portfolio, it takes the volatility out of the portfolio. So that's interesting. You would mention that.
Yeah, that's perfect. The other one I wanted to talk about is, or the one I find unique, is the Brompton Sustainable Real Assets Dividend ETF. So this also is a covered call ETF. It's active with covered calls. That's what it says on your website. It has a yield of a little over 4%. And I find that, it got my attention because anything to do with real assets, real estate, it's quite rare to have it in a covered call solution. So I see that it's 32% real estate. There's some energy in there, industrial. So when someone says real assets, what's included in that? What makes it unique and defensive?
Sure. I mean, the real assets theme, I think, is really interesting and has a lot of legs ahead of it. I think it's something that many investors could use, especially in today's environment. So the idea is that this fund focuses on companies who have, large investments, I guess, to make in order to establish their businesses. And what I'm talking about is, as you say, right, a utility would have to build, a giant power plant that's full of steel and concrete and very, very, very costly, billions of dollars perhaps to build at the onset. Same kind of thing for a pipelines company. They're crossing Canada with an 18-inch steel pipe, probably two of them or so on the same route, is not inexpensive, and there's a lot of material input to that. So covers real estate also. It also can cover materials companies, like if you've got a gold miner, they have a claim on a giant deposit of gold that has yet to be extracted, but it's a real material that they own and that they'll run their business around. So the businesses of these companies are centered on quite expensive assets that are made of solid materials, and so you get a couple of benefits from that. In an inflationary environment, the replacement cost, like if I was going to go out and compete with TransCanada and replicate all their pipeline systems across Canada and North America, that kind of thing, and try to take away the business. Well, I couldn't even, just with the price of commodities where they've gone recently in this inflationary environment. We're seeing 40-year high levels of inflation currently, like around 7-8% on an annualized basis, and that's affecting basic metals, right? So I got to go buy all that steel, and it's more expensive than it was a couple of years ago to go and replicate. All these companies too they're such large investments that need to be made, but they're vital to the operation of the economy. So governments will get on board and they'll permit these companies, and they'll protect their business positions. They're not going to allow me to just go out and build some pipes and start competing, because I got to go and get all these approvals and sign all these agreements with different landowners and that kind of thing, right? So there's material there's impediments to me just going up and starting up a business to take away their business. If I was a software business, depending on how unique my software was, somebody with a couple of computer programmers in their garage could go and start up a company and be bigger and take away all my business in a couple of years. It's not as regulated. There's not as much startup costs involved in that kind of business. But for real assets companies, they're protected, and the value of the equipment that they own or of the deposits in the ground that they own, it goes up with inflation, and so it gives investors some level of inflation protection. And then finally, a lot of them are very cash generative too, which is something I know your investors and your followers like. So there's a number of things to recommend real assets investing. On top of that, we've wrapped in an ESG process. We've integrated that into the investment selection process. So our portfolio managers are evaluating whether these companies are either already good operators from an environmental, social, and governance view, or if they haven't been, if they've stumbled, what steps are they taking to improve and to remedy their business, and are they moving in the right direction to improve their standings as an ESG company? So there's that as well, that sustainability aspect in terms of being good or improving actors in an ESG framework.
Awesome explanation. I couldn't have asked for anything better. I love the word you used, vital. So vital is, these are real assets. It's things that you could touch. And just to go back to your ESG, the ESG score, I'm not sure if it's up to date, but it's a B score on the website. So this is the type of stuff that I preach as defensive. Infrastructure, real estate, these are real assets. And another cool thing that I tell my audience members is, because many of them, who love cash flow income, those are the people who get drawn to my channel. They always say or compare it to buying real estate and just owning apartment buildings. And my response to that is, I love real estate as well. I love it as an investment, but instead of owning it, dealing with tenants and the hard, managing it day to day, you could actually invest in real estate, real assets via the stock market. So a lot of them never really knew this option. And this is the type of fund that would definitely suit someone who's coming from that background. I have a lot of clients or audience members that have apartment buildings. They're fed up. They sell them. They want to invest in something. So they love real estate. They love real assets. It makes them feel comfortable. So this would be a perfect fund for them, right? Because it literally is real assets. And like you said, companies that have been around a long time, that it's very, very difficult to replicate. I can't just start a Brookfield infrastructure company on my own, but I could maybe start a software company, like you said, right? So it's perfect. It's exactly how you explained it. So really cool ETF. I really like this one. I find it's very unique, very niche. And I'll talk to Michelle about it as well, but you actually have a split fund also that's infrastructure. and real assets. Green, it focuses on green energy. I'll talk to
That's
Michelle
great.
about it. But yeah, I mean, you have the ETF, you have the split fund. Really, really cool. Really, really unique. Last thing I want to talk to you about. I know we're going a lot of time here, a long time, but
I have time.
Okay, perfect. Good. I have time
Yeah.
also.
Good.
So
Good.
you guys had a very cool, popular preferred shares ETF called FFI.UN, which you guys recently switched from a closed-end fund to an ETF, right?
Yeah.
So the ETF I'm talking about here is, and you actually have two of them. You have one that's not leveraged. So that's BP. So that's Bravo, Papa, Romeo, Frank. That's I'm talking about the Brompton, Flaherty, and well, I have problems with that one.
You have to be a leprechaun to say that properly. Flaherty. I'm Irish. I have an Irish background, so I can say those names.
Okay, yeah, it sounded perfect when you said it. That's for sure.
Yeah, it's Brompton. I'll say it for you. Brompton,
yeah.
Flaherty, and Crumrine, investment grade North. Sorry, I'm going to start that again. Can you edit this out? Brompton, Flaherty, and Crumrine investment grade preferred ETF.
Yeah. Okay.
And so that's BPRF. And then
yes.
we have the enhanced version of BPRF. That the ticker symbol is BEPR. And as you noted, it's going to operate with leverage in between 25 and 33% of total assets.
Yeah.
So I'll tell you a little bit about that ETF and why we converted it. Well, we've been working with Flaherty and Crumrine for a long time, since December 2004, when FFI.UN, the former ticker of BEPR, was launched in an IPO. It was a closed-end fund. So we did one capital raise, and then it was closed. And so Flaherty and Crumrine has been operating that fund since then. Their focus is quite unique. They're a specialty asset manager located in Pasadena, California, and their only asset that they manage is U.S. preferred shares.
Wow, so they're specialized really in that.
They are, and
awesome.
So I mean, preferred shares in the U.S. Are kind of the same as preferred shares in Canada in a number of ways, in that a preferred share is a type of equity, but it's not a common equity. That basically a common equity owns all the upside in the company, right? If investors think that if the company is going to increase earnings, those all go to the after costs, all go to common shareholders, and you have more upside growth potential in common equity. Preferred equity is also equity, but instead of focusing on growth, it's focused on the income component. So preferred equity will have a par value or a base value. $25 is a common value. Some have $1,000 par values. But it'll offer a coupon as well. Mm-hmm. A coupon can be a fixed coupon, it's the same forever, or it can be any manner of adjustable strategies too. You can have a fixed for 5 to 10 years, and then it floats based on an underlying government treasury rate plus a spread, and it's reset occasionally. That's called a fixed to float. In Canada, a common kind is fixed to fixed rate reset. So you'll have an initial rate, and then after 5 years, it'll reset to a new level based on Government of Canada 5-year rate plus a spread. So in that way, they're kind of similar to Canadian prefs, but the main difference is in the U.S. The preferred share market is about 10 times bigger, so you get a lot more liquidity. It's got a more diverse investor base. In Canada, preferred share market, I've seen estimates that about 80% of the investors are retail investors. Now, I love retail investors. I am a retail investor, but in a lot of ways, only retail investors, sometimes they'll all think and act in the same way. So you'll see things like the sell-offs that occurred repeatedly over the last 10 years in the Canadian preferred share market, based on something that if there were more institutional investors, there might be more buyers and it might have stabilized the market, right? So having all of one view in the market isn't necessarily good for stability in the market. In the US, there's a lot of retail investors, but there's more institutional investors participating in preferred shares. Yields tend to be a little bit higher in the US, and you also get an international investor base too. BPRF is actually a good example. BPRF is an international investor to the US pref market, but there's also Japanese insurance companies, or you might have a European sovereign fund that was also interested in US prefs. So you start to bring in a whole lot of diversity of investors. You start to get a more stable market. You start to find that the retail investors might want to sell, but the institutional investors see value and they step up and they buy and they stabilize the market, right? So that's what we were going for, and that's what I think we've achieved to a large extent in FFI over the years. It is a leveraged investment in the U.S. pref market. It pays quite a high level of distribution, and it has its ups and downs, right? The market is an equity market still. During the credit crisis, for example, a lot of financial issuers saw their preferred shares and their common equity boom, just slam down kind of thing, right? And we've seen, these kinds of things happen in Canada too. So it's not a T-bill, it's not a T-bond, anything like that, but it's a very attractive coupon driven type of market. And our PMs have a specialty. Flirting Farmline has a specialty in that market, and they've done a very good job creating value for investors. So we managed FFI as a closed-end fund for over 15 years, almost 16 years actually. And we originated BPRF as a new ETF when we came to market with our ETF suite. That was originated in October of 2018, near the beginning of our ETF efforts. We had good uptake, and we had satisfied in BPRF, and we had quite satisfied long-term investors in BEPR. The ETF structure makes more sense though going forward. So we converted that to an ETF. It gives the investors that used to own FFI better liquidity, because you get better market making support when you offer an ETF. Right. And it also gives us the opportunity to offer it to more investors and to grow the fund. So now whenever, if enough investors buy it on the TSX, then new units are created and the fund gets bigger and costs are spread out over a larger group, and it just gets to be a better and better deal as we do grow that fund. So that I don't know if that told you everything you wanted to know, or if it's too much.
More than it did. I learned a lot actually, so I really appreciate that. I love learning and soaking in more information, especially about preferred shares, because I don't really knew exactly how they work. And in my book, I look at them kind of like a hybrid between fixed income and equity, where you kind of have a little bit of both worlds. Like you said, it is still equity, but it's more, it's safer. There's a coupon. It kind of acts like fixed income. And there's
a hybrid is an excellent description. Hybrid is an excellent description. It is at the crossroads of common equity and debt. So,
I think I read that on Investopedia somewhere, and it stuck with me. It made sense for me. But what I really like is that first of all, preferred share ETFs there's not many in Canada, and if there are, they're usually focused on Canada, and the yield is less than the US one. I could tell right away. But what's special about this one, and in my opinion, well, I think anyway, this is a very unique one. I'm talking about BEPR here because it's leveraged. I haven't seen any preferred share ETF that's leveraged. So the actual yield, I'm looking at it now, is over 7% yield, which is pretty incredible for preferred shares. Usually you'll get 5.5, something like that on the US market, maybe 4.5 on the Canadian market. So really, really cool. What's the leverage on that? Is it 25%? Is it 20%?
Currently, it's around 30%, but that can flex. Yeah, that can flex, and it's at the PM's discretion as to whether they want to leverage up a little bit. If they think that now is a good time to be more invested in the pref market, maybe because prices are down. We've had a rough year across all fixed income so far this year. US prefs has done better than most, but they've everything is down. So it's up to the PMs whether they want to leverage up, but in situations where the market is drawn right down, that's a good way to kind of make excess returns. I mean, the pref market more or less fluctuates around the par level, the par being the initial offering price level. So over time, you find that there's opportunities to buy or maybe opportunities to leverage up a little bit more, but ultimately, the income is what drives it, and just being a very high income area has produced a lot of success for Flirting Farmline in the actively managed US pref space.
Yeah, well, I love the fact that they're specialized. It always gives me confidence when it's a fund manager that's specialized in a certain niche that's managing the fund. So if they're specialized in preferred shares, it gives me more confidence, and it doesn't bother me with the leverage. In fact, I welcome the leverage because it'll just boost the yield. Plus, it's preferred shares; it's a bit lower risk. So I mean, BEPR, very interesting ETF, Chris. I would definitely suggest it. I'm talking to my audience members. If you're more of a conservative investor who wants preferred shares, but if you want over 7% yield on it, this is a unique product. And also BLOV and BREA as well, the real assets covered call ETF and the low volatility dividend ETF. Really, really cool, unique offerings from Brompton. So I know I tortured you for like an hour or something like that. I'm done.
That was pretty mild torture. If that was torture, I quite enjoyed it, actually. It was good talking to you today, Adrian.
I could talk to guys like you all day, honestly, about this stuff. I mean, this is what I like. I always like soaking in more information, getting different perspectives, because I could just give more information to the audience, which I know they appreciate. So I want to say a big thank you to you, Chris, and Brompton for your great funds, your great website, and your time. And I'm really looking forward to speaking to Michelle about the split funds, because I love the Brompton split funds as well. There are also some really cool and unique ones on that side as well. So I'll leave it to you if you have any last words, but on my end, I'm going to shut up now. I'm good with the question. So go ahead.
Well, I just really thank you for having me on today, Adrian. It was good chatting with you. You got some very insightful questions, and so I appreciated that. I just want to thank all your followers as well for following Adrian and for appreciating Brompton funds. I think that's great that we've got a strong audience out there for our products. We try our best to offer products with integrity, and so it's very satisfying to see people that like that appreciate that.
Glad to hear it. And come back anytime if you have a new fund or new anything. You let me know, and we could do this again. You're always welcome to come back and discuss your good products with us. So once again, thanks again, Chris, and we'll talk another time. See you next time.
Okay, great. Would love that. Take care, Adrian.
Thanks for watching, everyone. Really appreciate it. Make sure to hit that like button, that thumbs up button. It helps the channel grow, so it's a win-win. Also, make sure to subscribe if you're not already subscribed, not to miss out on my future content. It's all about income-focused investing. And also, you got to be subscribed if you want to participate in my surveys where I ask the audience, I ask you what topic you want me to cover next. So very important. Subscribe, hit that little bell button so you are notified of any new videos and any new surveys as well. Make sure to check out our website. We have a website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. So this is a reference tool. It's a companion tool to help you build your own custom portfolio. It's good for Canadian investors and American investors. So it covers both the Canadian and American stock markets. It has sample portfolios as well, multiple sample portfolios for different investing styles. So it's a very cool product, and it does come with lifetime updates. So you only have to purchase it once. My intention is to come out with a new version every single year. So you purchase it once, you never have to pay for it ever again. You'll get the lifetime, the updates for free forever. Also, right there on my homepage on the website, I do offer a one-on-one coaching session. If ever you want a little more personalized help, it's a 1-hour Zoom call with yours truly, a one-on-one with me where you could ask me anything you want. We'll go through your situation and I'll give you my opinion on how best, I'll help you best I can, basically based on my opinions. Just keep in mind that I am not a licensed or registered financial advisor or financial planner. We also have a Facebook group, so join us there. Passive Income Investing, over 11,000 members. We try to get the spams and the scammers out of there as quickly as possible. So it's a very, very clean group. Everyone's asking questions, trying to help each other. And it's a really, really cool and fun community. If you want a little bit more personalized stuff on our day-to-day life, follow us on Instagram as well. We recently moved to Panama, so if you want some more information on more personal stuff, you could follow us on Instagram. My mission, the mission of this channel, will always remain the same, everyone. It's to help everyday, regular, normal, working people to invest on their own, do-it-yourself investing, right, in order to build their own stream of passive income to enhance their quality of life and one day become financially free, financially independent. Very important goal. So, as usual, I continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.